the world headquarters of the Wall Street Journal in New York, this is the Wall Street Journal Report.
Welcome to the Wall Street Journal Report. I'm Consuelo Mack. Here's a quick preview of what we have in store for you in the next half hour. Is a new worldwide oil cartel possible? Will other oil producers join OPEC's club? We'll talk with Bill Randall, Wall Street's #1 rated oil analyst. Plus, the latest in zapping. It turns out the more money you make, the more you zap those TV ads, giving the networks a multi-million-dollar headache. And as we gallop into Derby Week, we have some surprising news for all of you itching to race into the sport of kings. In Money Matters, it's investing in thoroughbreds. But first, the economy, which is setting a faster pace than many may have predicted. The evidence, well, gross national product, which is the broadest measure of the economy's health, was up a respectable 2.3% in the first 3 months of the year. Consumers and business led the charge by increasing their spending. And if the leading economic indicators are to be believed, such progress will continue. The index, which economists use to predict future growth, was up a strong 0.8% in March. But there is a dark side to this bright outlook. Higher demand for goods and services can lead to higher prices.
I think we're going to be in a above 3% growth rate for the balance of the year, then tailing down somewhat as we go into 1989. Unfortunately, the good growth rate, improvement in the labor market, is going to be combined with a rising inflation. And the inflation rate could easily be above 6% later in the year, and even higher than that next year.
Those inflation fears caused investors to step aside to see where interest rates would go. The fear is that in order to keep inflation under control, the Federal Reserve will tighten credit and raise rates. Trading was light all week. The Dow made a sizable gain on Monday, picked up another 8 points on Tuesday, followed by a gain of 3 points on Wednesday, then dropped 6 in the slowest session of the entire year on Thursday. And finally on Friday, the Dow dropped another 9, but it still had a 17-point gain for the week. The bond market was hit hard by interest rate fears, and Tom Herman, who covers the credit markets for the Journal, is here to explain what happened. Now, Tom, a bank raised their prime rate on Friday from 8.5% to 8.75%. The question is this just the beginning?
But most of the bankers I've spoken to say yes, that higher interest rates are almost inevitable, at least over the next few weeks.
Why?
Because the economy looks like it's so strong that it's going to generate higher inflation. We're going to get some very important figures on Friday, the employment report from the Labor Department. That's the report that the Federal Reserve pays the most attention to of any government report, and that's expected to show more strength, which in turn is likely to generate more inflation fears.
Now, by reading your column, I've discovered that about 3 weeks ago, the Fed did tighten credit and did raise interest rates a little bit. Now, are they going to do that again?
The betting is yes. I was just talking about this with Norman Robertson of the Mellon Bank. He thinks that the Federal Reserve will try and raise rates a little bit now so that they won't have to raise rates a lot more when the presidential campaign heats up.
Now, is that a dangerous game for the Fed to play, that kind of fine-tuning the economy? What will that essentially do to Wall Street?
A lot of economists think it is a very dangerous game. There's a lot of criticism of the Fed for trying to fine-tune the economy too much. A lot of people are afraid that inflation is going to get out of the bottle once again.
Now, the Fed is going to be watching this coming Friday's employment data. Is there a chance that if the employment data is weak, that the Fed, in fact, will not tighten credit, or do you think it is an inevitable action that they're going to take?
It's not inevitable. The Federal Reserve officials I've spoken to say that they are probably going to wait until after the employment numbers come out, and then they'll review them all at a meeting May 17th. At that meeting, they'll decide whether or not to pull the trigger and raise rates a little bit more. If the numbers are as strong as people expect, the Federal Reserve says they will probably raise rates another 0.25 percentage point.
And what is that going to do to the bond market, do you think?
That's unclear. The bond market may react favorably because if the Fed tightens credit, it might encourage people into thinking inflation will not go up. But it's very difficult to call.
We'll have to see what happens on Friday. Tom, thanks for joining us.
Thank you.
Still to come, zapping. Itchy fingers and TV remotes are driving advertisers crazy. And later, some say the crash in the horse business was far worse than Black Monday on Wall Street. As the Kentucky Derby draws near, we'll investigate investing in thoroughbreds.
A message from Payne Weber, one of America's leading full-service investment firms. Today, more and more people are asking about international investments. We're talking with one of Payne Webber's top investment executives in the area of global funds. Mike, why invest globally?
One half of the investment opportunities are outside of the United States. I think today there is an opportunity to take advantage of currencies, of interest rates, economic scenarios in each country to provide better diversification.
What's your global income fund about?
Our Global Income Fund, which is the largest of its kind, is a fund which is looking for a high level of current income, plus secondarily capital appreciation.
What about the quality of this fund?
The quality is high quality. The majority of the bonds are AA and AAA.
Is it expensive to get into?
It is not expensive. The minimum investment is $1,000.
For more information about Payne Webber's Master Global Income Fund, call Payne Webber at 800-828-6109.
If you've been struggling to save money for the extras in your life, maybe it's time to come up with a money plan. There are ways to get your budget out of the red and into the black.
Is your budget worth banking your future on? I'm Murray Feldman. We'll discover how the right money plan can turn your finances around.
Join business reporter Murray Feldman this week on Eyewitness News at noon, 5:30, and 11.
Superior Court's Whodunit Week.
You are paid to have sex with the members at Bloom? Yes.
Did this sex club owner kill one of his girls? Or was he framed by a club member?
I didn't do it.
You knew Margot White pretty well, didn't you?
I guess you could say that.
I do say that, Detective.
Like Sergeant Vale, you too had a relationship with the deceased.
No, I didn't mean that the way that it sounded.
The issues are real. The decision's final. Superior Court.
It's a quest for truth, Monday at 4. The Wall Street Journal Report is sponsored in part by the financial experts of Payne Webber.
Welcome back to the Wall Street Journal Report. Do you remember the energy crisis of the 1970s when OPEC tripled the price of oil overnight and gas station lines stretched for blocks? Well, if you do, the notion of a larger global oil cartel is a frightening one. But it's a possibility. OPEC is so unhappy with the slump in oil prices that for the first time, it invited non-OPEC members, or NOPEC countries as they are now being called, to join them in Vienna this week to discuss the problem. Well, will it work? We asked Charlie Maxwell, one of Wall Street's leading oil analysts, for his price outlook.
And I think for the next 2 years then, the price of oil will average something around 16 to 17 with all of these variations up and down. And motorists will find some seasonal changes at the pump, but basically the price of the gasoline and the heating oil and so on that we buy will be flat or slightly rising with inflation. No big problems, no big increase.
Joining me at the Journal is another top-rated oil analyst, Bill Randall of First Boston. Bill, do you agree with Charlie Maxwell that oil prices are going to hover in the $16 to $17 a barrel range?
I think we would be somewhat more optimistic than that. We think that OPEC prices will probably gravitate back towards $18 by mid-year, even though this set of meetings this week seems to have failed to accomplish what they had set out to do.
Yeah, why do you think that? And also, what impact will it have on the consumer?
Well, we think that, you know, in the end, economics will win out over politics. And, for example, the difference between a $12 OPEC price and an $18 OPEC price amounts to $100 million per day revenue to OPEC.
But they've had a hard time getting their act together so far.
They have indeed. There have been some deep political rifts within the organization that has hurt them, their unity.
Now, if they can't get together, what are the possibilities of them adding, you know, non-OPEC producers and really getting together and forming a worldwide oil cartel?
Well, I think while this week's meetings were a start in the right direction for OPEC, NOPEC, WOPEC, World Organization of Petroleum Exporting Countries, it's a lot harder to get 20 people to agree to something than it is 13. So I think that's a long way away from having a world unity on that subject.
All right. As far as your outlook and attitude towards oil, gasoline prices, energy prices in general, what is it, essentially?
Well, I think for this driving season, consumers ought to be prepared to pay anywhere from 5 to 8 cents a gallon more. For this reason, the refiners are now able to raise prices for gasoline over and above the recovery in crude prices that we've seen from the early March lows to the present time, because demand is running at a 4.5% year-to-year increase and inventories are very low.
Bottom line, what companies will benefit from that?
Well, we've been recommending the major companies, but now we're also recommending the independent refining companies like Ashland Oil, Diamond Shamrock, Refining and Marketing, and Total Petroleum, a company that's covered by Tom Petrie and myself.
Great. Bill Randall, thanks for joining us. Appreciate it.
Thank you.
Still ahead, the fast track, investing in racehorses. Plus, TV viewers are zapping ads right and left. Only a lucky few, including Miss Rockstar, are escaping. We'll find out more in just a moment.
It's the best-selling vehicle of its kind in the country, probably because it's beautiful to look at and exciting to drive. Rare qualities in a car, and even rarer in a wagon.
Winning the world over. Have you been behind the wheel? Winning the world over. Have you driven a Ford lately?
Question. Does your mind shut off when the business day ends? Of course not. You're always alert. Quick to spot changes in the financial universe affecting your money, your life, your health, your future. You recognize a valuable resource, one of America's most experienced insurance, financial, and health service experts, the Travelers. You're better off under the umbrella.
Attention smart bedroom shoppers. It's a gigantic clearance sale at Waterbed Gallery Superstores. Save 10 to 64% on waterbed accessories, sheets, comforters, and many other home furnishings. Waterbed starting at just $98. Only Monday is this waterbed $158. And only Monday is our entire selection of bedroom furniture drastically reduced. Some limited quantities do exist, so hurry. Discover the largest selection and the lowest prices. Discover Waterbed Gallery Superstores Monday.
This is a well-known cliche. Hi, I'm WJR's J.P. McCarthy, and each weeknight here on Channel 2, we'll show you a different cliche as part of WJR's Cartoon Cliche Giveaway. I'll give the clues the following day in my WJR morning radio show, and then open the lines for your answers. Each daily winner will receive a 20-inch Sony Color TV and a cliche sweatshirt. So tune in WJR Radio 76 weekday mornings, and watch Channel 2 weeknights between 5:30 and 6:30 for new cartoon cliches.
This is the Wall Street Journal Report, and we have a question for you. Are you a zapper? If you are, you have lots of company, and you are driving network executives crazy. In television advertising, ratings are king. They determine how much a network charges for ad spots. But now that cable TV offers dozens of choices and half of U.S. homes have remote controls, more viewers are changing channels or zapping when they hit a commercial break. While advertisers have always feared this, a new experimental rating system says commercial zapping is far worse than thought. And that means advertisers may not be getting their money's worth. Only a few ads apparently escape the zap. One of the exceptions is this one, starring rock singer Michael Jackson. Here to expound on zapping is Dennis Neal, who covers television for the Journal. Dennis, why is this new R.D. Percy rating system so controversial?
Advertisers had worried about zapping for years, but they were always told by the networks it's only taking away 2% of the audience or so. Along comes this new system from Percy, and it says in prime time, zapping alone is taking away 10% of the audience, and even more on other programs at other times.
Now, there's a big gap there, and a lot of network executives are saying that this Percy system is not credible. Do you think it is?
I don't know that it is, but it's an awfully good hint for the first time quantifying exactly how much zapping is going on out there. The network executives say the same thing about Nielsen's new people meter system, but nonetheless $8 billion in advertising spending is based on that very system that they don't like.
So do you think this new rating system will become accepted or not?
At the very least, it's going to change the way advertisers think and the way advertisers hammer on the networks for lower prices. Percy contends that its system will become a basis for the business within 2 years.
Oh, you think so?
I don't know, but at the very least, probably Nielsen will end up at some point thinking about matching that technology to be able to do the same thing that the new Percy system can
Right, so rate not only the programs, but also rate the commercials.
Exactly.
For the viewership. Now, is there any way to stop zapping? I mean, you know, what kind of things are zapped and what kind of things aren't zapped, or is it too early to tell?
For the avid zapper, there might be no way to get him, but a few things they are trying. Some programs don't get zapped as much. For some reason, L.A. law doesn't.
And they haven't quantified why yet, right?
They don't really know. If you advertise on a basketball game when there's another one on the rival network, up to 40% of your audience zaps away. So advertise on a sports program when it's the only sporting event on the air, you have a better chance.
But otherwise they zap between the two programs?
Exactly. They ping-pong back and forth. And a third thing might be do commercials that fool the viewer into thinking they are real programs when actually they turn out to be an ad. And you're seeing a little bit more of that on the tube now.
So we actually could see some difference in the commercials that are being broadcast. We might just see more production values and...
Perhaps so, which is going to cost more money to do, but they're certainly going to worry more about zapping now and go to greater lengths to try to stop it.
All right. The zapping certainly does not stop here. Thanks, Dennis Neal. Well, as higher technology leads to such phenomena as zapping, will television as we know it adapt, change radically, or just stay more or less the same? We caught up with some of the most powerful figures of the TV and entertainment industry and asked them to give us their vision of what TV will look like in the future.
I don't think it's going to be a great deal different than it is today. I think you're probably going to have something in the order of 10 nationally delivered network kinds of services and cable television is still going to be the primary means that people are going to receive those national services.
Video stores will become obsolete. The VCR will evolve into a much more intelligent mechanism and become integrated into the TV set.
As the demographic curve of the population keeps getting older, I think you'll see more music and more news and more sports and more things that are directed to the 35-plus audience.
If you're a sports fan and you live in one part of the country, you'll see more and more regionalization or coverage of sports events that might be a little closer to home, affect you more personally.
A few years after that, we'll see holographic television, where on Saturday afternoon you might roll up your living room carpet and see little football players running around on the carpet, a little holographic ball. I mean, there are many things like that will happen.
It's going to be more of the same, I think.
Coming up next, playing the ponies outside of the betting window. We're going to go to the track in Money Matters in a moment.
The money that you spent on calls to your mother last month, you could have gone to visit her.
Okay, dear. I'll leave tomorrow.
Northwest can make flying cheaper than talking. Just call us now and take advantage of our new lower fares. While other airlines have prohibited smoking on flights under 2 hours, only Northwest has eliminated smoking on all flights throughout North America.
Many financial opportunities offer protection, yet one stands out because it also offers potential for growth. The Traveler's Universal Life. Life insurance protection and tax-deferred growth opportunity. So you'll have a special kind of nest egg to secure the financial future of your family or business. Get the Traveler's Universal Life and watch your opportunities grow. The Travelers, you're better off under the umbrella.
Next time on The Judge.
Why did you run away to Toronto?
Because I didn't want Kennedy touching me anymore. I couldn't take it.
The truth is that you made up this story to avoid going to jail for stealing another car and for violating your probation.
No, he abused me.
That is completely false. I have never touched Bobby, and I never would.
If Wayne Kennedy had not forced you to have sexual relations with him, would you have taken the car and fled to Toronto?
Never in a million years.
Family Courtroom Drama, Monday at 7.
Do you know where your last meal came from? From out of the blue? Across the water? Across the border? Or did it come from more familiar ground? Michigan produces and processes enough delicious variety for 3 different meals a day for a year. So why eat food that's better traveled than you are? Buy Michigan. There's nothing like the great taste of home.
This week's Money Matters is brought to you by Payne Weber.
Welcome back to the Wall Street Journal Report. There's less than a week till post time in Louisville, where next weekend the mint juleps will be flowing at the Kentucky Derby. And if you've ever dreamed of standing in the winner's circle with your own thoroughbred, you are not alone. In this week's Money Matters, Ian Hunter joins us with advice on getting into the horse trade. Ian.
Well, Consuelo, owning a racehorse does have lures, glamour, excitement, fame, and fortune.
But few thoroughbreds are winners, and for many investors, the dream of horse ownership can be a financial nightmare. Merrill. Before you run off and harness a thoroughbred, you should decide whether you want to breed the horse or race it. The difference? Well, traditionally, breeding was the safer investment of the two with the bigger returns. But after peaking in 1984, prices have fallen dramatically due to an oversupply of thoroughbreds and lack of foreign investors who've been driving up prices, paying as much as $15 million for horses that had never raced. At the same time, racing purses have grown dramatically, so it's now easier to break even on your investment.
I do believe that the pendulum swing away from commercial breeding and into racing is very real, because while the returns of selling the young stock with racing potential have reduced over the past several years, the purses have greatly increased. A good horse now can earn over $1 million easily, and a top horse can earn $3 million a year.
But how to pick a good racehorse if you're not an expert yourself? We'll start by finding someone who knows the business. In the horse business, the trainer is the key.
I always said when I was training horses, I'd rather be lucky than smart. And I'd rather train for somebody who is lucky than smart.
And one way to get lucky is to claim a horse. A trainer can do that for you by putting down the money just before a claiming race. Some great champions of the past were claimed for just a few grand by savvy trainers.
There always is that possibility for the small investor to come in and put $30,000 to, say, buy a colt that might be named Spend-A-Buck, a Kentucky Derby winner, and have that colt syndicated for 2 years later after that purchase for $15 million.
The problem is the odds of that happening are hundreds of thousands to one. If you do buy one, then that's just the beginning of your investment. Get ready to keep your horse in hay and oats. Then there's your trainer and jockey. Total cost, an average of about $20,000 to $40,000 a year. Too much for many small investors to swallow. But don't give up dreams of the winner's circle yet. If you don't mind sharing the spotlight, there's another investment option, the partnership. In a partnership, a group of investors get together, put up a few $1,000s each, and own a horse, pooling all the expenses and the rewards.
They bring people and of different origins and groups, and they bring them in, and they can invest in small amounts, and yet have the participation value that you would have if you owned it as an individual.
But Paul Kornman, a longtime handicapper so successful he's now an owner, says partnerships are a mistake.
Stay out of them. I've been involved in partnerships. Now, some of them are quite good, but other times it seems that when you're successful, everyone has their own methods and theories. And that's when great difficulty comes about it. Other than that, just make sure that your partners are financially stable.
Partnerships became popular back in the 80s when the industry was booming. Even Wall Street was playing the ponies, Merrill Lynch and Prudential Bache among the big players.
Unfortunately, the vast majority of those limited partnerships proved to be unprofitable. I don't think that that was necessarily a tremendous surprise to lots of people in the business.
John Finney's been around horses all his life, doing billions of dollars in horse deals. He says it was not Kentucky partnerships that were the problem, it was City Slicker partners.
Wall Street came to our game as an amateur, and Wall Street looked at it as being something that was immediately marketable because, one, of this record run-up, and two, because of the exotic product. It's just like the amateur that catches the end of a bull market and gets bit by the bear.
The question still remains, is it a sound financial investment? Well, no one we spoke to had any figures on returns, and all emphasized the risk involved. But for many horse owners, the bottom line is not necessarily money.
It's a fun investment more than a sound investment.
It's very risky. There's no high grader in life than winning a race, however.
I honestly think that somebody that has $5,000 or $10,000 ought to keep it in their pocket because they're throwing it away.
And of course, there's always the dream that your horse will be another Seattle Slew, bought at auction for $17,000 and syndicated for $120 million.
Seattle Slew took a game Washington lumberman and a highly competent young vet, and took him from being reasonably well-off working stiffs to being on the verge of being seriously rich.
So if you're ready to pony up to the bank and invest in a thoroughbred, some say now may be the time to make your wager. That's because with yearling prices at 1981 levels, there could be some bargains out there, but still no guarantees. Consuelo?
Ian, back in the early 80s, there were a number of scandals involving horse partnerships. I mean, how can we avoid trouble in investing in those things?
Well, before you sign on the dotted line, you've got to be very careful that you're dealing with people you know that you can trust, be they the breeders, the trainers, or the partners. You want to look for a proven record of performance, not only at the track, but also at the bank, because in this particular business, winners beget winners.
That makes good horse sense,
Yes,
Ian.
it
Thanks
does.
very much. Well, in the meantime, if your inclination is to take Mel Immergut's advice, that is plunking your money down at the betting window instead of in a partnership, we have some Derby suggestions for you. It's been an especially confusing year without a single runaway favorite. So here are some tips from insiders.
I think Private Terms will win the Derby.
Well, if it's not the big filly, it'll be Private Terms.
I guess I'd go with 49er.
I'll take E, whoever he is, number 5.
Private Terms, Maryland horse undefeated. I don't know why he doesn't get the respect he should.
49er, the 2-year-old champion.
I got to go with Seeking the Goal. I love him. I think he really has a lot of potential, and I think he can go the distance too.
Private Terms.
Any reason?
7 for 7. Jockey's a friend of mine.
And just to see how Wall Street does at the track, we asked some of the top stock pickers and money managers to give it their best shot. So here goes. Larry Wachtell of True Base picks Private Terms on a hot streak with Vegas odds of 3-1. Eric Miller of Donaldson, Luskin, and Ginrette says 49er is a short shot at 8-1. One of Wall Street's hottest money managers, Elaine Garzarelli of Shearson, picks Winning Colors, the only filly in the race so far. And longtime market watcher Pierre Rinfrae is flying down to Louisville to put his money on Proper Reality, a long shot at 15-1. Rinfrae says that's what Wall Street needs right now, a healthy dose of Proper Reality. Well, another reality on Wall Street is management failure. In Monday's Wall Street Journal, we'll give you the 5 biggest reasons